Good. So I want us to quickly discuss how to set the context for a trade setup. Can you see my screen? Can you see my screen, Ben?
Yeah. I can see a screen.
Perfect. Okay. So this is as a result of studies that I've been doing and then refining my strategies and things that I'm putting together to be better in trading or in the forex. So, the context for my setup and what will I look at before I take a trade or I want to trade the market. So the number one thing um, is to look at structure and ascertain the bias and the trend within this structure. Okay. So when I say structure, what I want to say is swing. Swinging or swing structure, the swing structure. So one is to find a swing structure. Swing structure is from one point of the chart of price action to the other point of price action. As we know, market moves up and down, up and down. Then number two, and I will show this on the chart. Number two thing that I will look at or I have to look at in order to set my foundation for taking a trade is is within that swing structure or range to find my swing low and swing highs being formed. So I need to find my swing highs and swing lows being formed. And then number three is to look for liquidity. So liquidity is the reason why price will draw to certain levels or a certain direction. So I need to really train my eyes to be able to identify that within my swing range or structure, is there liquidity around? Is there liquidity above my swings or is there liquidity within? Okay. So, and then number four, I look for entry confirmation. And to help with that is the premium and discount zones using the Fibonacci, and to look for if there has been liquidity sweeps, also to look for candlestick confirmation, harmonic patterns, or chart patterns. That all can help me or confirm why my entry or the kind of entry that I will make. And then, but before I'll search for these four before I search for these four things, I have to first understand what market structure is. And I have to also learn how to use the Fibonacci or the Fib. Okay. And I also have to understand what liquidity is really and how to identify liquidity. So these are the things that we are going to look at right now in this session or in this series. So what let's first start with what market structure is. What is market structure?
Yeah, measure more still a syndical measurement. Okay. Also for Nepal, yeah, measure look
What
okay
is,
more.
what is market structure?
I'm
Uh,
not feeling like.
okay, so for us to be able to have um, a siren call, please let's try to mute if our mics are on so that we'll be able to have a very siren call. Perfect. So let's go to the chart. So this is a chart for, okay, let me use this chart rather. Good. This is the chart for um 31S, volatility 31S, volatility 31S. So let me take a little time to clean this chart, but let's do what we want to do first before we come to the real chart. So market structure, what is market structure? So um, in a bullish situation, and when I say bullish, I mean buys or when market is moving up. So as we know, the market moves up and then moves down and then moves up and then moves down. So when market is at the up like this, then we call it a bullish situation. And when it's going this way, it does what we call making highs and low, high and low, high and then probably a low. And then we expect another high. When it's moving like a snake, moving like this, we call it a bullish market. So the moment the market tends to come down like this and then fails to give us a new high and then makes a new low, from this point, then we begin to say the market is bearish, which means it's moving down, and we call it a bearish market. So in a bearish market, we are going to have low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, and lower low. So this is the structure. And when we see the market is moving up or down, up, down, up in sideways and not making any intention of going up or trending, then we call it consolidation or ranging market. So these are the three types of situations that we have. Okay. So let's take for example, so in a typical bullish situation, to understand market structure, we need to be seeing higher highs, lower highs, higher highs, lower highs. So let's say, for example, market moved from down. Let's say market was coming from the upside here, and it got down here, and then we saw it pushes up. The moment it drops down like this, and then pushes up to take out this area and makes this area, we call it break of structure. BOS, sorry. We call it BOS, BOS. Okay, we call this one BOS. Okay, here at the point where it breaks the previous high and makes a new high, we call it BOS. So we get a low and then we get another high. This point is also called BOS. So anytime a high is taken, a previous high is taken in a bullish situation, we call it break of structure. That is the BOS. Okay. But the first time that a BOS will happen, we can say, or it's also called change of character. Change of character. Okay. So this area is change of character. At the same time, the first break of structure. And what makes this bullish market strong is when we have the second BOS or second break of structure, then it means that we are really, 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 really bullish. So change of character is the first break of structure that happens on the market. I hope so. This is the foundation. This is how we can understand market structure. Okay. Because we need to understand market structure first in order for us to identify our swing, our swing structure. And that will help us ascertain our bias, okay, our bias for the day. So that's why we are trying to remind ourselves of what structure is. Good. So now that if we are in a bullish situation and we have break of structure, okay, we have break of structure to the upside like this, break of structure here. The expectation is that market should drop here and then go up. That is the expectation in a bullish situation. Okay. So the moment we have a break of structure, that low where price started moving up from to that and break the structure to that high, that range, the moment we see price falling after breaking of structure and does not give us a new high and start falling, the moment we see prices falling like this, okay, the moment we see price falling like this, the moment we see price falling like this, so let's pay attention. This low and the high that it gave us, this activity that is happening within, okay, okay, one, we've not taken that high out. And two, we've not taken this low also out. So within here, price is still working within this bullish structure. Why is it bullish? It's bullish because the last low, sorry, the last high was taken out, was broken. So now, within this substructures that are creating, is all within this range. So therefore, as long as this low has not been taken out, even though market is coming down, and it could even come down, down, up to the exact place, like equal. It could come down up to here. Still, we don't have a break of structure to the downside yet. We are still bullish. So within this range, then notice that I have said that we have to learn how to use the fib. The fib is the Fibonacci. So um, the fib is a tool on TradingView, and it was developed by Fibonacci, yeah, by the name. So you find it in the left side here, and this is it. I pick it, and you measure your swing range. So the swing range is, or the swing structure is the low that broke structure to that high before prices making substructures or reversing or dropping. So from this low to this high, you measure. Use the fib to measure. So with the fib, you can set your own parameters or numbers. You can go to settings, click on it. We have settings here and you can set. But for my own, what I'm using is 23%, 50%. The most important is 50%, 61.8%. And then, yeah, those are the most important. So the blue area is the middle, which is the 50%, and that is called equilibrium. Equili Equilibrium. And then above the 50% is called premium. And then below that 50% is called discount. Good. So If we are in a bullish market, okay, according to the smart market or the smart traders, we buy at discount. Even if you go to the real market, you want the sellers to give you discount before you buy. Anybody wants discount if they want to buy. And if you want to sell, you want to sell at a higher price, at a premium price. So we sell at premium and we buy at discount. So when once price trades below the equilibrium in this swing range, we'll start looking for buys below. Okay, below 50%. We start looking for buys. So let's see, price has traded into 61.8%. It traded into 76.8%. So within this area, what do you do? Then you look for entry confirmation. You look for your um, liquidity sweep. You look for your liquidity sweep in the discount zone. You look for your liquidity sweep. This is the discount zone in a bullish situation. You look for liquidity sweep, candlestick confirmation or harmonic patterns or chart patterns. Okay, so any of them that you feel comfortable using as confirmation for your trade, you start looking for them. You start looking for them. Okay, so around here. So some people will say if you see something like this, you say this is double bottom and therefore you want to buy like W. You want to buy from here. This is one bottom, this is the other bottom. Okay, some people might see engulfing candlesticks. They might see engulfing. Okay, there's a candle here. Maybe you're on 15 minutes. There's another candle engulfing like this, and then that will be your confirmation. So we will get into all those in later classes, but I'm giving you the basic idea. So around the discount zone, you can take in your buy. And where is your target? Your target is because we are expecting a bullish situation, you target getting us a new high. Okay. And the moment we get a new high, because this was the old high, we get a new high, it's very likely, and we have to expect that price will pull back again into this range. Okay. Because we are looking at higher high, lower highs. Price will pull back and give us another high. So when we get the new high, the move for price to pull back could also still be bit by bit. It could be going sub structures. It could be very swift, very impulsive, but we could still be going bit by bit. So in this sense, because we've taken out this high from this move here, there is a new break of structure, BOS, here, okay, at this point. And therefore, this low and this high becomes a new swing structure or swing range. And we can use our fib again to measure that range. And we expect to buy below the 50%, which is discount. Okay. So we just wait. Once this trade has been successful, we just wait. And then we buy inside 61.8% or 78.6% when our candlestick confirmations are available here, but we buy below. It could even drop into 100%. Okay, then we buy. So this is the basic bullish setup. Okay, this is the basic. There is more to it, why you have to buy, but this is the basic way market moves or the structure moves or is supposed to move. Okay, now let's say in a real life situation, um, we were expecting to buy at this at this discount zone, and then market broke the 78.6% here and dropped down. So dropping down means it broke the 100% here. This will normally be your stop loss. Once it breaks here, it means that we are having a new change, or BOS, break of structure. We are changing direction to the downside. So what do we expect? We expect a push. So once this happens, if price start moving up like this, if price start moving up like this, you don't just jump on and start selling, okay? If price is moving up like this. So what do you have to ask yourself? What was the last high that gave us this low? Okay, so the last high was here, up here. So that high and this low becomes your new bearish range, like this. It becomes your new bearish range, like this. Okay, so what do you wait for? You wait for market. Normally, the normal thing is you wait for market to give us premium, which is above 50%, somewhere here. And then you can now start to look for confirmation to sell to the downside. But when you sell and market or price does not give us a new low, definitely around somewhere here, there will be a reaction above the equilibrium, or here, there will be a reaction. But once you sell and it does not give us a new low, because it is this second break of structure that will confirm the bearish movement. So many people will wait for this second break, and then on the next push, then they will enter their sell trades. That is being at the safer side. But if you want to be aggressive, you can find for you can find your cells here. If it breaks structure, then we are good. If it doesn't and ends somewhere here, and you see price start moving up like this again, it means that we are still bullish. The meaning of this is that price took out this low as liquidity, as it took out this low as liquidity. And then after taking this low, stopping as sitting or crashing our stop losses, taking us out of the market, it reverses. In real life situation, that is what happens. Okay. So what do you do? Once this has happened, you have to now find your entry to go join the bullish market. Okay. It's not complex, it's simple to join the bullish market. So if you once it breaks structure like this, now there is this area of low, there is this low here, and there is this low here. Okay, so this area becomes your protection. Why? Because it already took liquidity here, and therefore we would market would would expect market to drop to take out this as this structure as structural liquidity. Okay, we don't expect this high to go. We expect this the low that is very close to the all-time low here, the protection, to be taken out, and then we can see a bigger move to the upside. Okay, so we started from the basic structure as to how market should move in a bullish situation to a very complex one, where what we expect in real life will not happen. So when it doesn't happen, and it does like it that it happens like that because the smart traders and the banks and then the large corporations that comes into the market with big amount of volumes of money, they want to take all the retail traders out. They know retailers will be buying here. So they want to take all of us out, stop us, put us in loss, take our money, and then they will push the price to the intended direction. Let's see that price already broke structure here, giving us a sign that we are going up. But it ran into taking liquidity, stop losses. Okay. Those who will be selling here because price has broken structure, all of them will also be stopped out when price is going up. Okay. So that is the way that the market moves. So now, what do we have to understand? So this is an introduction to this concept. We need to, one, understand market structure, understand the swing range or structure. We are able to identify our swing low, swing high. The most important thing is liquidity. Okay. What is the market likely to use as liquidity in price action? So that is the pain. If you are able to master what the market is using as liquidity, or if you're able to master and see, train your eyes to identify liquidity, then you are going to really do well in this market. You're going to anticipate and know that market is moving here because it wants to take liquidity. Or you know that, okay, market stopped me out because, yes, it took me as liquidity. Okay, so let's see a live situation. The call might end in few minutes, and we would have to I will send a new link for us to do the second session before we close for the day. Good. So let me go on daily time frame, or let me go to 8-hour time frame for this pair, which is let's study this pair. Okay, so let me clear all this. Let me go to daily time frame first. Okay, so this is the pair. Okay, so what can you see from this daily time frame on this pair? Okay, so we can see that we want to learn the structure of this pair. So price started from the up here, it dropped down to this area, and we saw that it pushed up to here and drop again. So this is a bearish situation. It's moving down. So a low, lower high. Drop down again into this area, low. Let me put it here rather. Low, and then give us a lower high. Lower high here. Okay. And from here, it dropped again into this area of low and gave us a lower high. So this is the structure. When you see the market moving this way, you call it a bearish market. Okay. Then we see market from here, and this is kind of like an equal high. So we can say market drop into this area, and then we saw a push to this area. And then finally, market drops into this area. And then the last lower high we have seen is here. Is this place. This is the last lower high that we have seen. After this high and this low, we've not seen price taken out here. And price has not also given us a new low yet. Okay. So it is When are we going to say there is a break of structure to the upside? When are we going to say there is a confirmation to buy? It's only when this high has been taken out from the daily time frame perspective. If price is to move from this area and give us something like this, then we will say there is BOS, break of structure, or the first change of character, because this is the high, the last lower high. Okay, low, low, lower high. Okay, so once price breaks that, what do we expect? So what do we do from here? If price moves up to break here, this becomes our range, and therefore we use the Fibonacci to measure this range. And where do we find our buys? We find our buys below 50%. So inside this area, we expect to, that is what we expect. We expect to have a new higher high from this discount zone below the 50%. But if price drops after giving us this break of structure, which is the real thing that mostly happens, if price drops to give us